It is Thursday, January 29, 2026. Welcome back to another deep dive.
Good to be here.
So today we are doing something that I feel like I should almost apologize for in advance,
Oh, boy.
but then I'm going to immediately take that apology back. We're looking at the absolute bedrock of the global economy. And I know the moment I say the word commodities, a certain percentage of you listening are probably, instinctively reaching for that skip button.
You hear commodities, you think rocks and crops.
Exactly. You think boring, static, old world. You think, why aren't we talking about the latest AI model?
Which is a huge mistake. I mean, I get the impulse. I really do. But it's a mistake.
Right. And that's why I wanted to get into this specific research compendium today. Because if you look at the 2026 commodity outlook we have in front of us, it's not boring at all. It's actually flashing red.
It is.
It's arguing that these raw materials, oil, gold, copper, they're the scoreboard. They're telling us something very specific and, frankly, a little bit alarming about where the world is heading right now.
I can go a step further. It's less of a scoreboard and, more of a warning light on the dashboard. If you read through this equity research, the main takeaway isn't just about supply and demand anymore. It's about divergence. We're seeing this massive split in the global economy.
The split between what?
Between the, let's call it the old industrial economy and this new kind of strange financial reality we're living in. We're sitting on a nice edge between completely different economic futures.
And the way you position yourself in commodities this year, it all depends on which side of that knife you think we're going to fall on.
Exactly.
Okay, so let's define the game board then. The research relies really heavily on this concept of macro regimes, and sounds a bit academic, almost like sci-fi. Regime identification.
Yeah, it does.
But they argue this is the only rule book that matters for 2026. Break that down for us. What does regime identification actually mean for an investor? Why can't I just buy a good company and hold it?
Think of it like farming. You don't plant corn in the winter, right?
Right.
It doesn't matter how good your seeds are. If the season is wrong, the crop fails. Regime identification is just, Wall Street speak for knowing what season the economy is in.
So you can't just blindly pick a stock because the company looks good on paper.
No, you have to know if we're in a season of expansion or a season of, say, stagflation.
But here's the problem, and the report is pretty honest about this. The weather forecast seems to be changing every few hours.
It does. And that's what makes 2026 so difficult. The signals are really mixed.
So let's look at the wardrobe, so to speak, the current institutional allocation. Where is the big money sitting right now?
It's heavy on the old favorites. The current institutional index weightings are roughly 30% energy, 31% agriculture, and about 19% precious metals.
So that's the baseline.
That's the baseline. But the research is practically screaming that this baseline is dangerous because it assumes a normal weather pattern.
And looking at the headlines, we are definitely not in normal. The report lays out 4 distinct scenarios, 4 different seasons that could hit us. I want to walk through these because the implications for your money are, totally different in each one.
Right.
Let's start with the optimist's view. Scenario 1, global expansion.
Right, the Goldilocks zone. This is the scenario where, the Fed sticks the landing, inflation cools, and growth picks up again.
So good for everyone.
If this happens, you want to own pretty much everything. But specifically, you want industrial metals and energy.
Why those in particular?
Because expansion means building. It means bridges, roads, infrastructure. And crucially for 2026, it means the AI boom continues unchecked. And that requires massive amounts of power and materials. In this scenario, copper and oil are basically the fuel for that fire.
Okay, that's the dream. But let's look at reality. Scenario 2 is what the report calls late cycle moderation.
Right.
This feels like where we actually are today, doesn't it?
It feels very close to home, yeah. This is the cooling off period. In this regime, growth slows down, and it slows down significantly.
And that's bad news for energy.
Very bad. The report explicitly warns about margin compression here. Basically, we have a surplus of oil, and we'll get to that 2 million barrel surplus later. But if growth slows, nobody needs that extra oil.
So prices crash.
Prices crash.
What about industrial metals? Do they hold up?
Usually not. They typically take a hit, too. The source suggests a drawdown of like 15 to 19% is pretty standard in this phase. If you're holding copper in a moderation phase, you're usually losing money.
Because factories just aren't ordering as much wire.
Exactly.
Which brings us to scenario 3. The one that keeps portfolio managers up at night.
Stagflation.
The tail risk.
Yeah, they put a 50% probability on this, which is uncomfortably high. Stagflation is that toxic brew of high inflation and zero growth. It's the worst of both worlds.
It sounds like the 1970s all over again. If that happens, stocks get crushed, bonds get crushed. Is there anywhere to hide?
There's really only one place. Precious metals.
Gold.
Gold. In a stagflationary environment, gold doesn't just survive, it dominates. It becomes the primary driver of returns because it's the only thing that holds value when cash is losing its purchasing power.
Okay, and finally, scenario 4, recession, the hard landing.
The demand crash. In this scenario, the report projects Brent crude could hit a floor of about $51 per barrel.
$51. Oh, that must destroy the industry, right?
It completely wipes out profit margins for almost everyone except, the Saudis.
Yeah.
It's a collapse. But again, gold becomes the defensive king.
It actually goes up.
Historically, gold returns about positive 9% during these contractions while everything else is bleeding out.
So when you look at those 4 scenarios, you realize why the old allocation, that 30% in energy, might be really risky.
It is.
You're exposed to the downside in 3 out of the 4 scenarios.
Exactly. You're holding a bag of explosives hoping nobody lights a match. And that's why the research recommends a very specific institutional weighting adjustment.
They're not saying sell everything.
No, not at all. They're just recommending overweighting the metals complex to 25%.
Why 25%? That's very specific.
It's calculated as a kind of structural buffer. If growth stalls, precious metals give you a safety net that oil and wheat just can't provide right now. It's about building a portfolio that can survive the bad weather, not just the good weather.
There's another variable here that we have to talk about because you can't talk about commodity prices without talking about the currency they're priced in.
Yes.
The report calls it the inverse twin.
The currency vector, yes.
This is one of those things that sounds complicated, but is actually pretty simple mechanics, right?
It is simple mechanics.
Walk us through the relationship between the dollar and, the stuff we pull out of the ground.
So most global commodities, oil, gold, copper, they're priced in U.S. dollars. It's the standard. So just think of the dollar and commodities on a seesaw. If the dollar gets heavy and goes up, commodities tend to go down. They become more expensive for everyone else in the world, people using euros or yen to buy, so demand drops.
But if the dollar gets light,
commodities fly. And that is the context for January 2026. The Federal Reserve is on a rate cut path.
Right.
And when you cut interest rates, you generally weaken your currency. The research points out that this acts as a multiplier for metals.
So not only do you have the fundamental demand for gold, but you also have the dollar getting weaker underneath it, pushing it up even further.
Exactly. But there's a new player on the field. Or maybe an old player acting in a new way.
Who's that?
Central banks.
The report mentions they're aggressively diversifying.
That's a polite way of saying they don't trust the dollar as much as they used to.
Yeah.
Central banks, China, India, a lot of emerging markets are buying gold to buffer against USD volatility.
You want a neutral asset.
They want a neutral asset, and what this does is it creates a structural floor for gold prices.
It's like having a buyer of last resort.
It is. Even if speculative investors get spooked and sell, the central banks are there to scoop it up. That limits the downside significantly.
Which brings us to the star of the show for 2026. Precious metals. The numbers here are, well, I had to double check them.
They're staggering figures.
We're seeing spot gold exceeding 4,300, and Goldman Sachs has targets reaching 4,900. I remember when 2,000 was considered the unbreakable ceiling.
We're more than double that now.
I have to ask, is this a bubble? It feels like crypto numbers.
It does feel a little parabolic, but the report calls it a paradigm shift, and I kind of tend to agree. Gold isn't just a safe haven anymore.
It's not just insurance.
Right. Usually you buy gold just to not lose money. But right now, it's in a phase of what they call aggressive margin expansion.
Okay, hold on. Explain margin expansion to me like I'm 5. Because usually when costs go up in the world, margins go down.
Okay, so imagine you run a lemonade stand. It costs you $1 to make a cup of lemonade. The sugar, lemons, cup, everything. Last year, you sold it for $2. Your profit is $1. But this year, people are panicking about a thirst apocalypse. So they're willing to pay $5 for that same cup.
Okay.
But, and this is the key part, it still only costs you $1 to make it. Your profit just jumped from $1 to $4. You didn't do anything different. The market just handed you a massive raise.
And that's what's happening to the gold miners. Their costs aren't skyrocketing with the gold price.
That is exactly what is happening. Their costs, what they call all-in sustaining costs, or AISC, have remained relatively stable. I mean, they've already built the mines, they've bought the equipment.
But the price of what they're selling has doubled.
Exactly. That gap is pure, unadulterated profit.
So the miners are just printing money. Who are the big winners here? The report spotlights a few names. Let's start with Newmont, ticker NENM.
The pure play leader. If you want maximum exposure to gold prices, this is it. They're projecting 2025 revenue around, what, $21.8 billion? But the number that jumps out is the earnings growth, 74% year over year.
74% growth for a company that digs rocks out of the ground is insane.
It is. That's tech startup numbers.
It is. And it shows the leverage they have to the gold price. Every dollar gold goes up, their earnings go up exponentially.
Then there's Barrick, ticker B. The report calls them the strategic hybrid. Why hybrid?
Barrick is interesting because they're not just gold. They have massive copper exposure. So they get the benefit of the gold rally, the safety trade, but they also get to ride the electrification boom.
So it's a two-pronged attack.
It's a two-pronged attack. If the economy crashes, their gold works. If the economy booms, their copper works. It's a built-in hedge.
Smart. And what about Agnico Eagle, AEM?
The efficiency play. These guys are the operators, just laser-focused on cost control. The report projects 84% earnings growth through 2025 for them. They're just betting on being the most efficient gold miner in the world.
Now, for the listener who thinks, Newmont and Barrick are too boring, too blue chip, the report does mention some smaller players. Yes, the small caps. U.S. Gold Corps is mentioned for high upside, basically a leveraged bet on the price. And Kinross is highlighted for their cost containment strategies.
But the big takeaway isn't about picking one small stock.
No, it's that the entire sector is flush with cash.
Okay, so gold is having a party. The miners are buying yachts. But let's pivot to the other side of the room, the energy sector. It seems like the mood there is grim.
It's a massive hangover. This is the divergence we talked about at the start. While metals are surging, energy is facing some severe headwinds. The report projects a 2.0 million barrel per day oil surplus by mid-2026.
2 million barrels a day. Put that in perspective for me. Is that a lot?
It's massive. That's more than the entire daily consumption of huge economies like France or the UK.
Yeah.
It's oil with literally nowhere to go.
And where is it coming from? Is this just U.S. shale pumping too much?
It's a mix. U.S. production is still high, but you also have efficiency gains. Cars use less gas. The grid is getting greener. Demand just isn't keeping up with the supply capabilities we built over the last decade.
So if there's a glut, prices drop. What does that do to the energy companies?
It forces them into defense mode. The strategy for energy in 2026 isn't about growth. It's cash flow resilience. They aren't drilling new wells to expand. They're just trying to keep the dividends flowing.
So if you have to be in energy, maybe you need those dividends, where do you hide?
You go to the giants, ExxonMobil and Chevron. The report calls them defensive anchors. They just have the lowest break-even points in the industry. Even if oil drops to $50, Exxon can still make money.
But a smaller fracker in West Texas?
They might go bankrupt.
They also mentioned Cheniere, ticker LNG. That seems like a bright spot.
LNG, liquefied natural gas, is an exception, yeah. The export demand is still there, particularly from Europe and Asia trying to secure their energy security.
Well,
So Cheniere is capitalizing on that specific niche.
okay, so energy is defensive, gold is the growth engine. But let's go back to metals for a second, specifically industrial metals.
Right.
Because the report contrasts energy with copper, and this is where the future comes in, the AI power race.
This is one of the most important insights in the whole document, I think. We usually think of AI in terms of software, chatbots, code, NVIDIA chips. It feels ethereal.
It's in the cloud. We think of the cloud as magic.
Right. But the cloud is a physical place. It's a data center filled with thousands of servers running hot, and AI requires massive, unprecedented amounts of power, much more than standard computing.
And to move that power, you need copper.
You need a lot of copper. So it has a structural demand floor because of AI.
So even if the broader economy slows down.
Exactly. Even if we hit that late cycle moderation, Google, Microsoft, Amazon, they aren't going to stop building data centers. That race is existential for them. So that means the demand for copper is locked in, regardless of what GDP does.
And looking at the numbers, copper's capturing, what, $11,400 per ton? Who's the copper king here?
Freeport-McMoRan, ticker FCX. And what's fascinating is how the market is starting to view them now.
How so?
They're being seen as technology adjacent.
That is a hell of a rebrand for a mining company. We're not digging dirt, we're tech adjacent.
It sounds like marketing spin, but it's true. You cannot have the AI revolution without the physical grid to power it. Freeport supplies the grid, So in a way, they're the pick and shovel play for the AI gold rush, literally.
Okay, let's move to the third pillar of commodities. We've done the rocks, let's do the crops. Agriculture.
The defensive anchor.
And I assume this is just because, recession or not, people need to eat.
Inelastic demand, exactly. Doesn't matter what interest rates are, you still need lunch. So this sector is rated mixed positive to defensive.
No.
But success here isn't about a boon in prices like gold.
No.
It's all about margin management.
Explain that. Why is it different?
In ag, you can't really control the price of corn or wheat that's set by the global market. What you can control is the spread between your input costs, fertilizer, feed, transport, and your sale price.
They highlight Tyson Foods as a specific example of this working well.
Yeah, Tyson ticker TSN. They've had a massive recovery. In Q1 2025, their operating income jumped 60%. And specifically, their chicken margins expanded to 8.8%.
Why chicken? Is there a chicken craze I missed?
Chicken is the trade-down protein. When the economy gets tight, people stop buying steak and they start buying chicken. Tyson benefits from that consumer shift. It's a recession-proof behavior.
And who else is in the mix here?
Archer Daniels Midland, ADM, they're kind of the middlemen of the food world. Their nutrition segment profit is up 24%. And then there's Nutrien, NTR, which is the fertilizer play. But the report notes that Nutrien is very seasonal. You have to time it with the planting cycles.
So we've got these different sectors acting in completely different ways. But here is where it gets really interesting for me, the corporate psychology.
Yes.
The report talks about how these companies are hedging their bets. And there's a massive shift in behavior happening in 2026 that tells us what the CEOs really think.
This is the tell. If you want to know what a CEO believes, don't listen to their earnings call where they spin everything. Look at their hedging book.
So explain hedging quickly for the listener who might not be a futures trader.
Hedging is just insurance. If you're a gold miner, you might sell your future gold today at a fixed price, say $3,000, just to guarantee you make a profit, even if the price crashes tomorrow.
You cap your upside to protect your downside.
Exactly.
So what are the gold miners doing right now?
They've stopped hedging.
Completely. Isn't that just gambling?
For the most part, yes, they've stopped. And sure, it's a gamble, but it reflects their view. They are moving from floor protection to upside capture.
Right.
They see that $4,900 price target, and they want every single penny of it.
So they're supremely confident prices are going higher.
Supremely confident. It's a very aggressive stance.
But energy is doing the opposite.
Completely the opposite. The energy companies are terrified. They see that 2 million barrel surplus coming, so they're using futures and swaps to protect the floor. They're locking in prices now, even if they aren't great prices, just to survive a potential drop.
That is a stark difference. Gold miners are playing offense. Energy is playing defense. What about the agribusiness guys?
They're playing the mechanics game. They're hedging what's called the crush spread.
The crush spread. That sounds violent.
It's just processing. You take soybeans, you crush them to make meal and oil. The spread is the difference between the cost of the raw bean and the price of the meal and oil.
So they're just locking in their processing margin.
Exactly. Companies like ADM don't care if beans are $10 or $20. They just want to lock in that margin in the middle. They're playing it safe, keeping the factory lights on.
So you have gold miners betting the house on growth, energy companies building bunkers, and ag companies just trying to maintain equilibrium. That psychology really underscores the divergence we talked about at the beginning.
It really does. It shows that commodities isn't one asset class anymore. It has fractured. You can't just buy an ETF called commodities and hope for the best.
So let's bring this all together. We've covered the regimes, the dollar, the sectors, the psychology. What is the strategic verdict of this deep dive? If I'm the listener sitting here with my portfolio, what is the clear takeaway?
The verdict is pretty clear. The market has bifurcated. On one side, you have the metals complex. They're decoupling from cyclical fears
Why?
because of the rate cuts and that structural AI demand we talked about. So the strategy is overweight precious and industrial metals. You want exposure to that margin expansion and that tech-adjacent growth.
And the other side of the market.
Neutral or underweight on energy and agriculture. Yeah, surpluses in oil and agriculture is defensive, but it just lacks the explosive catalyst. It's a stay-safe zone, not a get-rich zone.
So buy the metal, be careful with the oil.
In a nutshell, yes.
It's fascinating how the narrative has shifted. 5 years ago, the line was, commodities are a hedge against inflation. Now it sounds more like commodities are the physical infrastructure of the future.
That is the key takeaway. The intersection of macroeconomics like interest rates and technology like AI is playing out in the ground, literally.
Before we wrap up, I want to leave our listeners with a thought that really stuck with me while reading this. We spend so much time talking about the digital future, the metaverse, AI, the cloud. We think of it as existing in code, just floating in the ether.
Oh, it doesn't.
No, this deep dive proves that the digital future is heavy. It's physical. It's made of copper.
It connects the digital world back to the physical constraints of our planet.
Exactly. If you are bullish on AI, you have to ask yourself, where is the wire coming from? The code might be infinite, but the copper isn't. How does that change how you view tech investing when the bottleneck might be a mine in the ground, not a chip in a server?
That is the multi-trillion-dollar question. And the companies that control the ground, well, they control the bottleneck.
And on that note, we will leave you to ponder the physical weight of the digital world. Thanks for diving deep with us today.
Always a pleasure.
We'll see you on the next one.